I'm about to break down the latest market moves. CPI cools, PPI pops. What does it mean for you? Rate cuts were priced in, then ripped away. Is the Fed trapped between falling energy and rising factory costs? This tug of war could impact your money in big ways. Stay tuned to see how to navigate this financial landscape.
Gary, thing number one, CPI, take it away.
All right. For those of you who are not glued to macroeconomics news on a regular basis, CPI stands for the Consumer Price Index. It's a monthly report that comes out when you hear people talking about inflation. They are typically talking about the CPI. Now, one of the things we've complained about at Deep Knowledge Investing is that the CPI is intentionally understated. It is designed to be inaccurate. And we can get into those reasons and what's going on, why it happens that way, the way they manipulate that another time. But anyway, for those of you who are new here, the Consumer Price Index is what people typically refer to as inflation. Now, last month, we got an overall increase of 2.7% for the year and an increase of 0.2% for the month. That annualizes to 2.4%. The market was looking for as much as 0.4% for the month, so it came in light. That annual number of 2.7% is flat from June and was 0.1% below expectations. The core CPI, that is the CPI excluding food and energy, because as you know, nobody needs those things, was up 3.1% versus last year and up 0.3% for the month. That yearly core number was above last month's 2.9%, not the direction they want to go, and 0.1% above expectations. The main reason for that is shelter, which is a fancy word for inflation. The monthly was consistent with last month and in line with expectations. Going to some of the categories, and just so you know, every month I put out a 9 or 10 page report going through all the details. I don't paywall that. So for those of you who are interested, if you go to deepknowledgeinvesting.com, just click on the research tab and you can see in the blog, the monthly CPI report. For those of you who want more detail. Anyway, food inflation still elevated at around 3%. I still think that's too low. If your grocery bill is up only 3% for the last year, I'd love to hear from you. Put it in the comments. You'd be the first person to tell me, yeah, my food inflation is a single digit number. Energy prices continue to be a tailwind. They fell by 1.6%. And again, shelter is the key reason for the still too high CPI. Shelter, again, fancy word for housing. The one other thing that I want to emphasize is both President Trump and Federal Reserve Chairman Powell keep insisting that the current Fed funds rate is restrictive. One of the things we do at Deep Knowledge Investing is we track real interest rates. That is the CPI, the Consumer Price Index, less the Fed funds rate. And you know what? I actually just said that the wrong way. Pardon me. That is the Fed funds rate, less the CPI. But that is still below 2%. I assure you, for those of you who are long-term macro watchers, a real rate under 2% is not restrictive. So we're going to disagree with both the chairman and the president on that particular point.
Gary, my immediate thought turns to what everyone wants to talk about, and I'm sure what everyone would be interested in when it comes to CPI versus PPI is what does this mean for tariffs, rate cuts, right? How does it affect the case, obviously, that President Trump has for rate cuts, and obviously how he's using these tariffs within deal negotiations?
Well, Rob, so let's look at what people think is going to happen, and then let's talk about what's going to happen. So we saw people's expectations shift wildly during the week. When the CPI came out, because it was below expectations, everybody said, wow, the Federal Reserve is going to cut rates at the next meeting that's coming up. And, you know, the expectation was for 25 basis points, just a fancy finance way of saying 0.25%. But the probability of that cut went above 100%. Now, you might say, well, wait a minute, how is that possible? The answer isn't that the probability of a cut went above 100%, but there were more people saying, you know, they might cut 50 basis points. Again, fancy finance way of saying 0.5%. So, you know, everybody was very excited about that. As I said, people were worried that the monthly increase would be 0.4% instead of the much more manageable 0.2%. Now, that was the direction we were headed until on Friday, the PPI came out, the producer price index. And that came in really, really hot, like scorching hot, like way above expectations. And the supposition there is that some of the tariff expenses are starting to make their way into the producer price index. Now, the reason this matters and the reason the Fed is in such a precarious position at the moment is because price increases go through the producer price index first, then the consumer price index. Now, that might sound confusing, but it actually makes sense. Think about it this way. You're running a plant and you're making goods that people want. I don't know. People love to use widgets as a fictional item. Okay, so we've got tariffs. Tires, exactly. Okay, so we've got tariffs, and say the price of tires or the steel that goes in the tires or the rubber that's used in the tires goes up. Well, Michelin and Goodyear will see that in their prices first. They say, oh my God, well, our prices are up. Guess what, consumer? We have to raise our prices. And a few months down the road, we see higher tire prices. So Chairman Powell is in a really rough position because the CPI seemed kind of manageable, but the PPI is indicating, we've got a lot of inflation coming. And so that caused people to say, they might have to pause. Now, what people will be watching is later this week, Chairman Powell will be speaking out west. There's a conference out there, and he's typically used that as a way to...
Maybe I'll go try and meet him.
Yeah, there you go. Go see. Tell him he can have a free subscription to Deep Knowledge Investing if he needs a better understanding of what's going on.
Invite him on the show and tell him, hey, we're just trying to see both sides.
Good idea. Go to Jackson Hole and see if you can get him on the show. I like that idea.
Oh, is that west? Jackson Hole's west?
Well, it's west of where I am in Spain. So, actually, you know what, Rob? While you're doing that, send a note to the Oval Office. Let President Trump know we'd love to host a debate between him and Chairman Powell here on the 5 things. Anyway, as long as we're dreaming, we're going to move on. So Powell is going to be talking about this later in the week. And when he does that, people are going to be saying, wow, we're really curious. What's he saying? And they're going to be reading between the lines of everything he says. As usual, my guess is he's going to try not to be too direct on anything, any part of this. But the thing that we've talked about is I think the Fed is irrelevant. Whether the Fed keeps rates the same or they cut, it's not going to matter. And the reason is if they cut the Fed funds rate, which is just the overnight rate, you're going to see a higher 5-year, a higher 10-year, a higher 20-year bond. The yield on that will be up. And the reason is the bond market will price in higher inflation. They'll take down bond prices. This is what we saw in the United States last September when the Fed started cutting. This is what Great Britain just saw. They cut their version of the overnight rate, their version of the Fed funds rate. And guess what? The yield on their 10-year rose. So I think if Chairman Powell gives President Trump what he wants, which is a lower Fed funds rate, it may end up going in a direction neither one of these guys want, which is a higher 10-year rate, higher mortgage rates. So basically, the only way we're going to be able to get our inflation problem down is a cut to congressional spending. The probability of that is right around 0. So I suggest to people that you prepare your portfolio for more inflation. If you're having trouble with that, guess what? The Deep Knowledge Investing portfolio is heavily hedged and prepared to make money for higher inflation. That's what we think is coming.
Yeah, Gary, you've always mentioned, hey, regardless of what the market looks like, what decisions are made that are obviously outside of our control, hey, here's how we can position ourselves for if this, then that type of conditional logic, I think, has been very interesting in learning how you position yourself and set up everything within the DKI portfolio.